Good morning all, and welcome to this morning's video. So this morning I have 4 pairs on watch, the market moving into some valuable areas which may or may not provide an opportunity. We shall see. But my favorite of the bunch is Kiwi dollar. I have Kiwi dollar, pound Swiss, Aussie Kiwi and pound dollar on watch. So my favorite is Kiwi dollar. So let's break that down for you now. Just trying to keep my trend lines excuse me, my ray lines rather, to a minimum. So just got the bare essentials on the chart today, just trying to keep things as simple as possible. So you can see this area of value here. You can see that we are gravitating back towards this area of value where the buyers would likely be looking to get out of their positions, and you can see that we've moved up there overall in this very non-progressive way. Okay, you can also see that we've wicked to the area. Okay, so normally these wicks get filled, especially when we don't quite tap into the area here. Okay, so you can see here what happens. We wick to the area, come down, come all the way back up. We wick to the area again. So we keep near missing at this area, suggesting to me, especially when we move up in a very non-progressive manner, that this is an attractive area for a sell. Okay, you can see as we drill down, this is already looking like a bit of an ending structure, okay, where we get the 1, 2, 3 like that. I am mindful of the fact that you can see that it's parallel, but I am mindful of the fact that, as I've said in previous videos, okay, when we get a corrective move into the middle section, and the middle section is impulsive, okay, often we have moved out of that impulsively, but often when we have this kind of impulsive middle section down, price will either do something like that to give the middle section more depth, so then we get a middle section like that, or we will get something like a 3-touch structural approach at the end. Okay, and that could be what's happening here, because you can kind of see this. You can kind of see this. We may come down here, form a bit more of a base, and then we end up with another little structure at the end. Okay, because of the fact that within this structure, okay, this middle section was impulsive. Okay, so that might be a bit hard for some of you to understand, but this is something I've noticed and observed a lot more recently, that stuck out to me a lot more recently. But regardless of how this shapes up, what I'm going to be looking for is the following. I'm going to be looking for price to tap into, break above, specifically in this instance, because this is such a valuable area, it stands out on the weekly chart. Does it stand out on the monthly? Not so much on the monthly, but because this stands out on the higher time frames and even on the weekly, okay, usually we break above before moving to the downside. So if we were to just tap this area, for example, literally just tap it and move down and flag, these trades, unless you get, a kind of 3-touch, maybe 1 hour like that, they're higher in risk, because usually we would break above. Okay, so if something happens the majority of the time, then anything. So if the majority of time we break above and then break back in and then correct, if we literally just tap the area and then flag this, this obviously carries more risk, because it's not what happens the majority of the time, meaning you could be tagged in, tagged out, then we break the high and then drop. Okay, so in this instance, I'll specifically be looking for price to break above the area of value that I just showed you on the higher time frames, and then a 1 hour impulse down below this area of interest, so that we're not retesting the back end of this. And then I'll be looking for a 2-touch 5-minute continuation, so either a correction afterwards with 6 to 8 corrective 5-minute candles as a minimum, and I would look to get short on the break, or a 15-minute continuation, so 6 to 8 corrective 15-minute candles. And if that was to occur, then I would look for the risk entry within the structure if I could get it. We had 2 bottoms, and if we didn't manage to get that, I would just let the original order trigger me in. Okay, so then I would be able to manage it down to that first inflection point, assuming we pushed up from here for something in the region of 3.5. We're 5% down to the lows. I would personally be targeting these lows down here, so down there, and then I would use the mechanical management tool, and I would measure from the range to the bottom there. I would set a take profit at the 90% mark, where price can often pull back deeply, and that would give us something in the region of 11% to work with. So that is Kiwi dollar. I have an alert set there. Let's see if it triggers. Okay, so that is Kiwi dollar. Pound Swiss. So pound Swiss on the higher time frames, you can see that we gravitated. So we had this long consolidation, which is a typical characteristic of pound Swiss. Where is the origin of this move? The move originated here. You can see that this is a separate structure. Okay, this is the origin of all of this. So it's no surprise to me that we gravitate back towards the origin of the move. We have a little bit of an ending structure here. We can see the three drives at least. The first drive, second drive, third drive, it breaks out. People think it's going to the moon. Many people would have been too zoomed in here and wouldn't have realized that they're actually trading into the high. Okay, then we break above. Many people think this is going to the moon because now apparently this becomes support. But what we see in the majority of the times is people get completely washed out like that. Okay, and it just plummets to the downside. So it seems like logical to me that if I was a seller here, I would be looking to get out somewhere. If we just zoom out to the weekly, I would be looking to get out of my positions if I was swing trading this. Okay, either at that low there or more likely down in that area. Okay, so you can see that we have the impulse correction potential continuation, and if we were to measure that and we assume that the impulsive legs within such a wave are usually of a similar length, that would take us down to that area. And if we were to measure it on the break, because the volume that's been built up within a correction can dictate how far we go, that would actually take us all the way down to there. But this is the one that stands out to me. So that would be where I would anticipate people getting out of their positions. So for a move to the downside, we would be well positioned. We would be well positioned on the lower time frames, because you can see we've had a nice sequence. We've had a sequence of tight corrections into a bit more of a running channel, okay, and then we've completely dropped out and then corrected below this below this structure. Okay, so there's no sharp pullbacks. We've not pulled back more than 50% of the range or anything like that. Okay, this is a nice sequence in my experience, a reliable looking sequence. So what are we looking for? Because this is a slightly, for this to happen by the end of, for price to get up there by the end of the day, I wouldn't just be looking to call the top of this structure. What I'll be looking for is I'll be looking for price to tap into that area, a little push down, and then either a 5-minute continuation or a 15-minute continuation, and then I'll be able to manage it down to the low for something in the region of nearly 3%. And in this instance, I would be targeting that low there. And you might be thinking, well, why that low and not the other one, not the one below? Well, if we just measure this for a second, so I'm measuring the range, okay, because I would mechanically manage this. If we measure the range from there to there, so the bottom of that, notice how that low there is almost bang on 90% of that range. Okay, so that is where, as I said, price can often pull back sharply. So rather than letting it do that, I would set a take profit there, okay, just before that wick, because it's the 90% mark, and then I would trail my stop loss down to that area as well. We could we could find our way all the way down to there, but that is often where price pulls back sharply. So I'd set the take profit there, and I would trail my stop loss accordingly. So that is pound Swiss. I have an alert set below the area of value. If it doesn't trigger, no trade for me. So Aussie Kiwi, this is a bit of a similar deal, but you can see we broke above here. Okay, you can see we had a significant high there. We had a significant high. Okay, and I said to you, normally we break above it. You can see we've literally only just slightly wicked above it. Okay, so technically it's a break above, but usually we would anticipate a bit more of a break above if we were going to move to the downside aggressively. So this to me looks like potentially the sellers getting trapped in too early, which we can see happened there. They get washed out and then it plummets to the downside. So again, look at this move here, okay, on the weekly chart. it seems logical to me that if I was a seller swing trading this, I wouldn't be looking to get out of my positions until at least there on the higher time frames, given that that's where the bigger players are looking to what they're looking at. In this instance, you might be wondering why I've got that there. Well, in this instance, it's more of a case of, we just look at this sequence, right? This is, you got to remember what pair this is. This is Aussie Kiwi. It's a corrective pair by nature, and this has been quite an impulsive run. So for price to get from here all the way down to there, the market needs to breathe. So for price to, if it was to tap into there, which is what I'll be looking for today, would that be enough volume for it to get all the way down to there? I highly doubt it, especially on a pair like Aussie Kiwi. So it would likely need to build volume along the way. So if that's the case, where would it likely build volume? Well, it would likely build volume here, and that's because if you look at this low, it's the base of all of this. You can see we're trading below this now. If you look at what's to the right, the base of all of this is here. And the base of this happens to be the retest of the back end of this and the retest of the back end of what was a sharp move. So that would be where I would anticipate price consolidating sideways for a period of time, even if I got my entry. And if you look at where price started to impulse as well, so we had this structure here, you can see we correctively moved down. We impulsively started moving down there. And if we just measure that, that lines up perfectly with that. So that makes contextual sense as well. So back on the higher time frames, am I positioned well for a move to the downside where I am? Yes, looks so to me. Am I positioned well on the lower time frames? Yes, we've completely dropped out of the previous correction. Is this a reliable looking sequence? Yes, you can see it's moving fluidly in a nice in a way that I would anticipate if we were going to move to the downside. There's nothing abnormal about that. And when I saw this, just to touch on it, I saw this little structure here, and this is the kind of thing that traps people in too early. So I was looking at this, right? And if you're too zoomed in, this is the sort of thing people will do. They'll see this, and that would have been more visible on the 15-minute chart. You can see that little structure there, and you think, yep, that's a nice little structure. But then you zoom out and you ask yourself, okay, wait a minute. You look at that move down and you ask yourself, does this look like enough volume for price to then blast to the downside from there? And what are people paying attention to? If they've seen this move, where are people likely to place their orders for a move to the downside? Well, you can see here there's an inflection point. So it stands out on the 4-hour chart, which carries more weight than the lower time frames. So I'm not surprised that price broke out of this little mini structure here and gravitated towards the more attractive area of value, which was visible on the 4-hour chart. And then, so then the next question I asked myself, if price was to, this is what we call an M style pattern, would that be enough volume if price moved up to there and then plummeted? Yeah, I would argue that's enough volume, especially just to take it down to that level. So I'm not surprised that price did exactly what I was anticipating last night. So with all of that in mind, what I'll be looking for today. So this is an M-style pattern where we get too much volume here, and instead of committing to the downside, we actually move up. And there's your M-style pattern, and that's what I was predicting last night. So what I'll be looking for is a tap into the area of value, a 1-hour impulse down below it, and then a 5-minute continuation or a 15-minute continuation. And you can see that this to me looks like the closest to being ready at this moment in time, but we shall see. The alert is set just below the area of value, and if it doesn't trigger, then guess what I won't be doing? I won't be looking to place a trade. So that is Aussie Kiwi, and then pound dollar. Pound dollar a little bit more, not quite as picturesque, but it's not necessarily about what's picturesque, it's about what's effective. You can see here that we have and you can see it's not as standout as well. This one, we have this, I've called it an area of inflection because the area of value that I'm interested in at the moment is up here. You can see, once again, you should be able to see that this is not, it doesn't stand out quite as much as the other pairs, this area of value, but you can see we are gravitating back towards there. Okay, and the price is moving up in a non-progressive manner. And if we just study the DXY quickly, it looks to me like the DXY, the dollar index, is trying to find its way down to here for then a move to the upside. Okay, so if that was to happen, so if DXY moves down slightly before a move up, then pound dollar will likely move up slightly before a move down. Okay, so that makes contextual sense, because as the dollar index is getting weaker, the pound is getting stronger. And then if the DXY starts to rally, okay, then the pound dollar will likely sell off. So that's just a little bit of a correlation that I was factoring in there. So you can see what happened. We have the area of value. We come back up. We near miss to it. Look at all these wicks. Buying pressure, buying pressure, buying pressure, more buying pressure. Okay, we've grabbed orders from below price. That gives me a clue that we'll likely gravitate back towards the highs. And if we've got a near miss to that high, where people, when it was in this area, would have likely been placing their orders, they would have been putting orders up here, we'll likely gravitate back towards that area. Once again, we have that kind of straight middle section like that. So we could push up from there, especially as we have this kind of 1, 2, potential 3. But because this middle section within this structure is kind of a straight line, I wouldn't be surprised if we push down, maybe tap into that area and then push up, and then this becomes the middle section, okay, within this whole structure. And obviously that would take a bit longer to form, but we don't know how the market's going to form. All I do know is that that is an area of value. That is the near miss to it. And if we got a tap into that area and we push down in this instance, because I wouldn't want to be retesting the back end of that, what's now an area of interest to me, I wouldn't want to be retesting the back of that because it is visible on the higher time frames. So I'll be looking for a tap into the area of value, and then a push down below that area of interest to the left. And then on the higher time frames, we just put that guy back in his box. On the higher time frames, if we just actually get that back, move that out of the way, we would be positioned below all of these highs, including that one. So we would be well positioned on the higher time frames. What's happened there? Right, let's get that guy back on the screen. We would be well positioned on the lower time frames. The sequence would likely be good, assuming it was the first flag, and then I would look to get short either with a 5-minute continuation or a 15-minute continuation. I would be able to manage this down to the low if we pushed up from where we are at the minute, something in the region of 3.5. Down to there, we would have 5.5, and down to here, we would have about 12.2. And once again, I would measure the range. So from here to there, and notice that we have a very, very sharp move. Okay, sat just above the 90% area. So when there's a sharp move sat just above the 90% area, I will set my take profit at the sharp move and not at the 90% area. And that would give us, because that's often where we can pull back deeply, that would give us something in the region of 10.5 to work with. Okay, so that's what I'm going to be looking for today, folks. I hope you have enjoyed this video. I have a webinar to attend, I believe, this morning in about 15 minutes' time. But for now, I shall bid you a great day, bid you a great weekend, and I'll see you again in the next video, which will likely be made next week. Have a great rest of your day, and I'll see you again soon.